Welcome back to Everything Money. We're glad you joined us again. If it's your first time here, this is the first time. My name's Seth. I'm a normal guy. I'm a wedding photographer for the past 10 years. I have two guys next to me, Paul and Mo. I bring your question, the questions you've had about business, about real estate, about stocks and investing. I bring them from my mind to theirs and say, what the heck is going on? A big talking point nowadays is this Cathie Wood and ARK investing, ARK ETF. Specifically today, we're going to talk about ARKK, ARKK, which is one of their ETF funds. Now, this fund is filled with a very large amount of hype stocks. We did a video on this a few months ago. It was very popular. So we're sort of do a take two on our thoughts. Paul is going to unload again on your thoughts about Cathie Wood. It's a very rare topic to say that Cathie Wood, you get a lot of, how could Cathie Wood be wrong? She's so esteemed. She's so wonderful. Give us your thoughts on this ETF, Cathie Wood in general, and why so many people are hyping this thing up because it's just the best thing ever. Go ahead, Paul.
So this is a chart. $20 7 years ago, 160 peak, and 118 now. Okay.
Amazing growth.
So what I want us to understand here is, I'll always hear people, when this was happening, I said, guys, she's wrong. Their comment is, yeah, but look at this, you're wrong. Okay, well, let's do that same argument. Here it is today. So is she wrong?
We're just buying the dip, Paul.
So we change our story. We change what matters to us based on what the chart says. Before, if I said historical times matter, they sit there and say, it depends how far. I'll sit there and say, when somebody says to me, Paul, this person's a great investor. Oh, really? Look, 2015 and now. I'm the only idiot in the world who didn't make money in this time. Everybody else did. Yeah, is it 5 times more? It is. But I always tell people it's about process. It's been proven time and time again that if you buy the most expensive companies over long periods of time, you lose a lot of money.
The point we're making, folks, is we have a wonderful Patreon. We have 3,300 members in it now, 3,200 members.
Yeah, 3,200
members. And one of the top comments we get is, I lost my butt investing in this garbage. And then when it didn't work out, I found your Everything Money YouTube channel. This is like every person, every message we get is the same story. YouTube sends you to hype people because they want to make money. They want you to watch the YouTube commercials. They send you these videos about how wonderful Cathie Wood and this ARK is. And we're here to show you that we disagree. Go ahead, Paul.
Yeah, so when I look at any sort of investment, I look at the cash flow. And the reason being, every investment is a future value, is the present value of all future cash flow. If I sat to you today and said, hey, I'm going to pay you $1 a year the rest of your life, you have to pay me something today. What would that $1 a year be worth to you? $1? Well, of course, you'd pay that all day.
Sure.
$10? Oh yeah, I mean, you have to basically live 10 more years and then you get your money back. You get a 10% return on your money.
Yep.
That's the whole thing. The problem we have with hype investments is when we don't understand the fact that you're buying a business and a cash flow and you're not buying a stock and just a ticker symbol, then it's hard to put your head around that. I had the same issue 20 years ago. I didn't believe I was buying a business. Then over time, I realized, wait a second, there's a disconnect here. And just like some of you out there who might be hearing me going, man, this makes sense. The same thing happened with me when I started hearing more about Warren Buffett and his beliefs. We all revere Warren Buffett, but then it's so funny to me when Warren Buffett says something like, buy ETFs, people say to me, see, Paul, stock picking is terrible. You shouldn't do that. Okay, Warren Buffett also says value matters. No, value investing is dead. Well, so which one do we care about here? You know what I mean? It's like, which one do we actually care about here? And Warren Buffett even says about ETFs, if you're not a professional investor, you should buy ETFs. The whole point I'm trying to make about ARK is we look at ARK and see hype going like this. And by the way, look at this price here. It was up a lot.
$56.
Yeah, but a big part, how much of this gain is because of Tesla?
Yeah.
She has Tesla as a big part of her portfolio. We can actually pull up, I have Y charts here, which pulls up the actual ingredients of this portfolio, the holdings, and this will be available soon for us. Tesla's our #1 holding.
What percent is it?
10%.
Wow.
And guess what? How much is Tesla down in the last few months?
I mean,
yeah, from 900 down to 600.
It's below $600 now.
Yeah, so it's down 33% right now, guys.
Yeah, it's $595.
The most hype stocks are the ones that drop the most when times are bad. That's just a fact. Go look at every other bubble in history. The ones that led the bubble are the ones that pop the worst. You look at NASDAQ in 2000. NASDAQ fell 83% from peak to bottom in 2000 in the bubble crash. Why? Those are the stocks that led the charge. I'm willing to bet a lot of money. ARK and the NASDAQ again this time has led the charge. They'll be the biggest drops. You can stamp this video right now. I've said it before. This will be a very, very bad. Guess what? When it finally is a value ETF at some point in the future, nobody will think so. She'll probably be out of a job. I mean, it's very likely. Like I always tell people, every hype time in history, every bubble, tell me a manager that came out of it and was fine for years and years. Mm-hmm. We don't hear about anybody anymore. No. So what we can do with our 8-pillar software is what I want to show you guys is, we once went and looked at all these top companies. I think only 3 of them made money, right? Yeah. We can put them in our 8-pillar portfolio. What this allows you to do is, and by the way, our software is 80 cents a day. It tells you everything you know about the stock from the 8 pillars. It gives you all the 8 pillars, gives you all the financials, gives you a stock analyzer tool. It gives you Discord with over 3,000 members in there. But we can input every single company in the 8-pillar portfolio, and it'll give you an overall checks and X's for the entire portfolio.
Yeah, I just noticed, Paul, she wisely put Coinbase stock in this holding recently, which is, of course, down 33% since it's open. So,
yeah. And she bought DraftKings yesterday.
Yeah, she did.
When somebody shorted them saying there was fraud.
Yeah.
Or illegal activity. All right, so we put all of these companies into our 8-pillar software to do the portfolio. PE ratio, what does this mean?
Overall, in all these companies,
they do not make money.
They do not make money.
Price to free cash flow, $11,800. $11,800. That means for every $1 of cash flow, you are paying $11,800 for it. Oh my God. Ain't nobody got time for that. Okay. Income growth. Their actual net income growth is down. Now, their revenue growth, as all these companies combined, is only up $67 billion in the last 5 years. It's $12 billion a year across how many companies? 20 companies?
How much is what's Apple's revenue in a year?
Yeah. Guys, this is even impressive revenue growth. Oh, good for them. They have cash on hand to pay their bills. Congratulations. Cash flow growth. $6 billion in cash flow growth over the last 5 years across 20 companies over 5 years.
That's awful.
20 companies over 5 years. That's literally $60 million a year per company in growth on free cash flow.
Apple reported $57 billion last year.
Awful. In what? In profit. Talk about revenue.
Oh, you're right, in profit.
$370 billion in revenue. So, guys, can I just? By the way, this is the revenue growth, not just the total revenue. Yeah. Revenue growth.
Okay.
So, guys, that analogy I had earlier, where I said, take this person to the car and slam your head in there.
Uh-oh.
If this makes sense to you, the number of shares outstanding has tripled. This isn't doubling, by the way, guys. If it was doubling, it'd be 100%. This is triple the number of shares outstanding. They are diluting the heck out of you in these companies as well. So even if you get the growth, if this continues, you're not going to see any of that growth in your shares. If this makes sense to you because you like disruption,
oh boy,
I will disrupt all day. Send me a check for $10,000 and you can have 0.1% of my business across this group. We have amazing growth potential. That's it. Good job, guys. I mean, I don't understand how this looks reasonable to you.
This is astonishing.
This is going to end up being very, very bad. Oh, by the way, total revenue, $93 billion. Total revenue.
Sweet.
Apple did $370 billion.
Sweet.
Market cap, $1.6 trillion. So guys, let's look at this. $1.6 trillion in market cap. Apple's $2.2 trillion. Revenue, $93 billion. Apple's $370 billion. 4 times the revenue. Net income, loss. Apple made $57 billion. But Paul, Apple's dead. Guys, this entire portfolio is $1.6 trillion.
25 stocks.
25 stocks, $1.6 trillion. Apple's $2.2 trillion. You have to look at what you're buying, what you're getting for what you're paying for. You are buying Apple for $2.2 trillion. You're buying all these companies for $1.6 trillion. You're getting a loss here versus $57 billion. Free cash flow of 5.9. What was Apple's free cash flow last year? Probably 60 or 90 billion.
Paul, I love asking normal people that I meet when I photograph them. You know, I bring up the show and they say, boy, I got this hot stock. You know, I got this stock tip from a buddy on a Facebook, yada, yada. And then I will pull it up real quick. And I'm like, you literally have to slow it down to like, why would you buy a business for $4 billion that literally makes $0? You wouldn't buy that, would you?
Of course not.
And they're just like, oh, I guess no. So then don't buy these. It's just
because they don't look at it as buying a business.
This isn't even close, Paul.
Not even close. Not even 11,800 times the last 5 years free cash flow. Last year, so here's the deal. Last year's free cash flow was $6 billion. So it's still, what's 1.6 trillion divided by 6 billion? 16, 60% of that, 2,600? Now, is that right?
Yes.
Oh my God. Is it really?
26,666.
Boom. Look at me. Math. So even last year's free cash flow is 2,600 times last year's free cash flow.
Mo, you are alarmed by the movement of this ETF being so unstable.
Yeah.
What should we be really looking for in quote unquote safe investments like ETFs?
I mean, to me, yeah, this is an ETF, but this is, to me, hiding under the
Yes.
word ETF. This is not an ETF. This is insane. ETFs are supposed to, the purpose of them and the definition of them really is to be sustained low-cost growth over time that you can go to, and it's not going to get you rich quick. You're not going to have 10% swings of an ETF. That just shouldn't happen. The thing that I'm really liking about this chart is, so Seth, you know we talk about these creations of these W formations.
Yes.
Look at how it went up like that. So it's creating new higher lows. Looking at it coming down, now it's like creating these, it's stuck at this point, but it's coming down. So I am liking, and today, it's creating those M formations of those lower highs. This is a strong pattern because this was a strong pattern. This is also a strong pattern on the downside. So those of you that are all hyped up about this ARK ETF and stuff, I mean, these things don't typically lie.
Possible short you're talking about then here?
Possible. It's not there yet, but I mean, technically it is an uptrend right now, but we know this thing does a lot of reversals. A lot of reversals, yeah. So this has potential to come down. And that pattern that I just showed you of these M formations, that's very powerful coming down because it's showing that it's creating a lot of resistance right here. It might create resistance right here, and it'll just be, they need a lot of volume and a lot of hype and a lot of this and that to push up and get back to those all-time highs.
For Paul's final take, if you think we're crazy, you're gonna see very young investors writing in the comments of how we're dinosaurs, this is stupid, we're missing out, you guys don't understand growth, yada, yada, yada. If you're not thinking of that, we only need very few of you to get on the train, and Paul's gonna explain what we mean by that, Paul, right? We're not looking, please explain it to me.
So, you know, a lot of YouTube channels want to grow. We want to grow too. But what's more important to us is grow with like-minded people who all want to learn. Does that mean we're all going to agree? Absolutely not. I still get people in the Discord saying, you know, Paul, I know you said this, I don't agree with this. That's great. Investing is about finding a process that works for you, right? We're trying to teach a process that works for us, and along the way, you will learn a process that works for you. Warren Buffett always says, it's better to buy a great business at a fair price than a fair business at a great price. I disagree. That is something I actually disagree with. He's also dealing with hundreds of billions of dollars of capital he has to deploy. He needs to find great businesses at fair prices. But as a small investor, you need to find fair businesses at great prices or great businesses at good prices, okay? You don't need to find them at an amazing price. Just find them at good prices. One example, because of Warren Buffett, so remember this. This group, $1.6 trillion. Berkshire Hathaway, $650 billion. So way smaller. About 60% smaller. This group, revenue $93 billion. Berkshire Hathaway, $365 billion in revenue. Okay. Net income, negative $6.5 billion. Net income, $104 billion. Okay. Free cash flow, $6 billion. Berkshire Hathaway free cash flow, $30 billion.
Jeez.
So guys, would you rather spend $650 billion buying $30 billion a year in free cash flow, or would you rather spend $1.6 trillion buying $6 billion in free cash flow, even if that free cash flow could grow by big numbers for the next 10, 15 years? Remember, disruptive companies aren't disruptive forever. They're disruptive for 10 or 15 years, and then they pretty much stabilize. Bill Gates in 1996 wrote a book called The Road Ahead, and in it he talked about, I remember reading this back then. I remember not believing it back then. He said, 20 years from now, we will not be the #1 tech company. There'll be a company out there that's bigger and better than us, and they probably don't even exist today. Fast forward, Google, Facebook, Apple did exist, but it's still the #1, but people then guessed that. But it wasn't #1 back then. It was actually close to bankruptcy back then. So I implore you to worry about free cash flow and earnings, and growth is important, but don't overpay for growth. When you buy this portfolio of stocks in ARK, you are overpaying for growth. You are absolutely overpaying for growth. There is no equivocation about it. Will some of these companies be around 20 years from now and a lot bigger? Probably. But the vast majority will not. You'll probably still end up losing money along the way.
If you love this beautiful software behind Paul, you can jump on our Patreon, click the link in the description below, join the 3,200 members in our community where you can talk, analyze stocks. There's funny channels. There's a whole community we're building. You get access to us and you get that software. You can have it right now. Go for it. That's our take on ARKK. It's terrible, and these companies are it's hilarious. It's actually hilarious that people, I don't even know what to say. I'm dumbfounded. Fondle the video. The like button, not the video. You can fondle whatever the hell you want. And patrons, you know I love you. I love you guys.